includes direct materials, direct labor, variable overhead, and a portion of this fixed overhead. You remember we took the fixed overhead and divided it by the units produced. In year one, you produced 50,000. In year two, you only produced 40,000. That tells me right there that those two numbers are going to be different for each of those years.
What was the third one not Lewis? Direct materials, direct labor, and what?
Direct materials, direct labor, variable overhead, and a piece of the fixed overhead. So in year one, I would take the 320 and I would divide it by the 50. But in year two, I'm going to take the 320 and divide it by the 40. And that's going to help me come up with that product cost per unit under absorption. So on your variable cost, these two numbers will be the same, year one and year two. Under your absorption cost, then these two numbers are going to be different because of the number of units you produce. So then you're going to come down here and you're going to set up your income statement under absorption. So you're going to have sales revenue, and then you're going to have cost of goods sold. You're going to subtract that to get your gross margin. And then you're going to subtract all your total selling and administrative expenses. They don't give it to you in total. They give it to you variable versus fixed. So make sure you take the variable S&A times the units sold for that year plus the fixed to get your total selling and admin. Okay? Y'all just recorded. Okay, again, when you build the sales here, year one and year two times the selling price based on the units sold. Your cost of goods sold, year one, the number of units you sold times the product cost. Year two, this is the tricky part, okay? I'm selling stuff that was sitting in inventory from last year, and it had last year's cost. And then I'm selling the stuff I produced this year, and it had this year's cost. You're gonna have to add it all together. So to get this number right here, you're gonna take the product cost times the units in inventory from year one. If I produced 50 and sold 40, I had 10,000 units in ending inventory. So 10,000 times that year one product cost. I'm gonna add that to the units that I produced during the second year times the year two cost. So that'll tell me the 10,000 at year one cost plus the 40,000 at year two cost gives me the total 50,000 that I sold, and I'm attaching the right cost to them. The old cost and the new cost. Are y'all with me on that one? Okay, so that's how you're gonna get this number. That number right there, just in year two, is the one that's gonna bother you, okay? And again, when you get down here, go back to your variable costing income statement, which was the first one you did up here, and pull down your net income for year one and year two, okay? It's gonna throw that down here, because it's going to calculate these cells. That's not what you want to end up here. What you want to end up in these two cells is whatever you get right here. So I'm just saying this is going to tell you to add or subtract. So figure out what you have to do to put there to make it work here. This is going to say the same thing, add or subtract or whatever in year two. Figure out what you got to put there to get that number right there. It has to do with what's in ending inventory. Yeah. Okay. I'll take that one.